Well, hello again, everyone. Welcome into Rain Over Money. This is Kevin Hissong. Thank you for joining me today on what is episode 15 of Rain Over Money. Today, we are going to talk about investing, speculation, and gambling. Three terms that unfortunately get intertwined sometimes, but we're going to break them down into three different areas. And I got to thinking about doing this episode because today is Thurby, based out of Louisville, Kentucky here. So it's a big week for horse racing and sports betting alike when it comes to the horses. So today is Thurby, kind of become the local version of everybody's day at the races. Oaks has become a bigger deal, and obviously Derby on Saturday, Oaks is on Friday, and Thursday is now Thurby. So it got me thinking about, it has to do a little bit with risk, I think, or actually a lot to do with risk and how much risk you're willing to take. And I think investing in general, you have to be able to burden some risk and take that on yourself. But there's definitely a difference in investing, speculation, and then gambling. And don't get me wrong, I like to gamble. I think my friends think I gamble more than I do. I enjoy it, especially when we come to Derby this weekend. I like to read the programs. I like to handicap this and that, and know a little bit about how to do that. And every now and then I'll get lucky. I think my wife is better than I am, definitely last year, picking the long shot. But with that said, I do enjoy that. With the online stuff now and a lot of the states around us and sports betting becoming more and more prevalent across the nation and becoming a bigger deal. You see it with commercials, you see the leagues getting tied to it professionally and everything. It's definitely a bigger deal. So when you combine, gambling becoming a bigger thing and social media and everything, people think, oh my gosh, I'm going to hit it big and, we're going to retire off one big hit and whatever. So I just kind of want to take a moment to talk about that and really the difference in gambling, speculation when it comes, and when I say speculation, I'll get into it in a minute, but speculation when it comes to picking stocks that maybe you think are going to pop and do what they call a 10 bagger. A 10 bagger would be growing 10 times what you've invested, or a 4 bagger is growing 4 times what you've invested, kind of a term they use. And then just general investing. What's the difference in three? Because I think a lot of people think investing in the stock market is gambling. They're scared to death of it, and it's just not the case. And so I want to get into that and talk about that. So thanks again for joining. Again, Kevin Hissong, Rain Over Money, episode 15 here, available on YouTube, wherever you get your podcasts. Visit the website at rainovermoney.com. So let's start with gambling. Let's start with gambling first, because that's the fun one. Everyone wants to talk about gambling. Whether it's horse racing, whether it's betting the ponies, whether it's betting on your favorite basketball or baseball team or soccer team or whatever have you, or whether it's going to the casinos or whatever. One thing I've learned over time, and you read about this and hear about this with more and more people, the more money you have, the less you're willing to part with it. And it's definitely been the case. I probably used to gamble and be more speculative about things and take on more risk with less money that I had. And I wish somebody would have sat me down a long time ago and said, that's not the way to go. Luckily, I never lost a ton of money or got into any issues with that, but I know people do from time to time. They get into gambling debt, get in over their head on gambles, whether it's real estate or whatever it may be, and get into trouble. So that could fall into gambling or speculation. So you've got to have some guidelines in place. And maybe by the time we get through this episode, you'll have an idea of some guidelines that'll help you along the way and make it fun for you. Because I think gambling is fun. It's great to, your horse to come in and win, or you pick 3 teams in a parlay and you get a nice payout or whatever it may be. It's fun, but it's not fun to lose more money than you're expecting to lose. And it downright makes you sad. I know I used to literally get sad about losing the money because I wasn't prepared to lose it. I really thought I was going to win, and that's just not the case. And that's the issue with social media. You see so much of the time, whether you follow a sports betting, or you see an article on Yahoo or MSNBC about the guy that hits a 12-team parlay, and a parlay is when you have to pick every game to win. So it's like you've got to pick 12 instead of just one to win. And the odds are exorbitant when it comes to a 12-team parlay. People turning like $5 into $500,000. And what you have to realize, and what makes it so much harder with social media, is that is one in a million shot. Of course, you're hearing about it because it's news and everyone gets excited about it, but it is such a one in a million shot. So whether it's hitting a 12-team parlay or what is it, Ethereum stock, or Ethereum coins, Bitcoin, whatever it may be. Now, I will say Bitcoin, I'm going to talk about Bitcoin in a second here, but all the other ones, there's so many other, electronic currencies out there and this and that everyone are kind of betting on because they have the potential to blow up. And that's okay for a little bit of your money. And that's what you have to figure out is from the investing standpoint, how much money are your investable assets? You should always know how much your investable assets currently stand at or roughly stand at, whether it's 50, you're just starting out, but you're getting things going, $50,000 or $100,000. Maybe you're lucky enough to hit $1 million or $2 million. That's your investable assets, and your investable assets should definitely not be intertwined with gambling. I think with your investable assets, if you're going to speculate on something and speculate on a stock, it can be part of your brokerage account or whatever, but you need to have some guardrails in place. So I'm just going to throw this out there. I was thinking about it, trying to run some numbers, and I'm thinking about myself personally. Let's say you've got $50,000. We'll start, $50,000 in investable assets. That's in your IRA, your joint, you're investing in your 401k, like we've talked about. You've opened a Roth IRA. But hey, you want to, you're going to Vegas for the weekend or whatnot, or you're going to the Kentucky Derby. What's a fair number to think about? So there's investing, there's speculation and gambling, and I'm not talking much about speculation yet, but gambling. Let's talk about speculation for a minute. So I talked about gambling. I think we all know what gambling is. Talked about investing. That's your S&P 500, your 401k. You're allocating across different asset classes, building towards a net worth for retirement, money you're going to continue to put away in things that have performed well and stood over the test of time. The S&P 500 over the last 50 years or so, I don't know, 7% annual return, 8%, 6% annual return, whatever it is. That's pretty solid. If you give me a 50-year track record of something that's returning that, I feel pretty confident in that. Same thing with like a Johnson & Johnson stock. They've raised their dividend for 40 consecutive years or whatever it is. I've talked about those dividend aristocrat companies that have consecutively returned their dividends. I feel like those are pretty good companies to invest in. They've stood the test of time. They've been through wars. They've been through pandemics. They've been through internet bubbles, whatever you have it. And they're still very profitable companies, and they're still continuing to raise their dividends. I feel good about investing in those companies. And I know that the S&P 500, on average, 3 out of every 4 years is going to give you a positive return. So those are things I'm prepared for the long term. And that's why we talk about investing. That's what you should be doing. That's where definitely the overall majority of your money should be going. Speculation's okay. When I first started investing outside of my 401k, opened a brokerage account, it was during the late 90s and the internet bubble. And I've mentioned this before, but continued to see that the Yahoo ticker across my screen, and everything's just blowing up and going up $10, $15, $20 a day. It was insane. And I don't know if we'll ever see anything like it again. So as soon as I saved up enough money, I invested in a brokerage account. And the first stock I bought was something called ZeroPlus.com. ZeroPlus.com, I think the ticker symbol was ZPLS, if I remember right. It was a telephone over the internet. It was free calling over the internet. And again, this is still when long distance were a big thing. We didn't really have cell phones. So hey, this could be a big savings. I was living in Louisville, Kentucky. My parents were in Ohio. I had friends that had moved away. So if we could talk over the internet for free, that'd be fantastic. And I actually bought a phone that plugged into my computer and this and that. And, we're talking dial-up speeds of, I don't know what we were at, 50,000, 50K back at the time. So I tried it out and it worked somewhat. It was definitely chalky listening and talking on it, but it worked. So I liked it. So I invested in the company. They weren't profitable. They had just started out. And I got lucky. I think I bought the stock around $4 a share, and it went up to like $13, and I sold the majority of it, and I held some of it, um, over a year or two, and then eventually it went kaput, and I lost whatever was left in the account. But that was speculation. That was, hey, this technology is starting to take off. I'm gonna, I like the idea of this company. I've actually tried it out. I like the way it works. I'm going to put, at that time, too much of my money into this individual stock. But that's speculation. Speculation is okay when you believe in something, or you've read some good things, or you have a belief, and you've done some research, maybe in an industry that you know well, of a company that's just starting out. I would put cannabis stocks definitely in the speculation category. I mentioned Bitcoin. I still think Bitcoin is speculative. It's edging on the investment side because I like the way it's reacting to the markets as a hedge, but I'm still not completely sold on it. But Bitcoin's kind of between it. It's moved from speculative into a little bit of the investment phase. All those other electronic currencies are definitely speculative, and I'm sure some of them will take off over time, and some people will be lucky enough to make enough money, some money on those, but again, it's just something you can't be putting a large chunk of your money in. It's okay to put a little bit. So for instance, going back to our $50,000 example, let's say you got $50,000. I don't think, and I believe this for ourselves personally, and I'm not even close to this when it comes to speculation for our investable assets. But I would say you don't want any more than 2% of your investable assets in speculative stocks or speculative ETFs or speculative industries. So let's say you got $50,000, you shouldn't have more than $1,000 invested in that. And the reason is because with speculative stocks or speculative ideas, you've got to be prepared for giant losses. And I think with speculation, you've got to be prepared to hold it through the horrible times. And that's tough because let's say you got $50,000, you decide to put $1,000 into, I don't know, I hate to promote it, but cannabis stock. And let's say that $1,000 goes all the way down to $150. It's done horrible. If you're only investing 2%, the reason I say that is because I would be okay to lose that 2%. Because my other investments, my 98% of my other investments are growing over time. I'm willing to risk losing that 2% of my portfolio for the potential that it could take off. So maybe that over time goes from, well, let's look at Bitcoin, for example. It was what, $100,000 at one time and went down to like $16,000, $18,000. And, some people luckily sold at the top. Some people rode it down to the bottom at 16 and continue to hold it. And now we're up back around 30,000 again. So you've got to be willing with speculation to ride out the bumps, give it plenty of time to do its thing, because there are many companies that were at one time speculative companies that have grown into fundamentally good companies, and people have made a killing on it. But you've got to be willing to wait it out over time. And that's why you can only allow a small portion of your overall portfolio to do that work. Everything else has to be focused on the overall market and small caps, mid caps, large caps, dividend growth, whatever it may be, the boring stocks and boring companies we talked about. The Johnson & Johnson, the Cintas's, uniform companies, things like that of the world. So that's why I think on speculative, no more than 2%. So let's talk about gambling for a second. Like I said, you go to Vegas. I love going to Vegas. My mother-in-law lives just outside Vegas, so we always fly into Vegas and fly out of Vegas. It makes it real easy for us. Got the Kentucky Derby here this weekend. If you like to gamble and if you want to gamble, I think it's okay to gamble, but you've got to be prepared to lose. The problem with gambling versus speculation is speculation, sometimes you may lose all your money. Sometimes you may just call it quits and say, I've held this thing for 5 years, it's never going to do anything. And instead of your $1,000 you invested, you've got $250 left, you may take it out. Investing, as long as you're investing in good, solid companies over the long term, as the S&P has grown and grown over the years and shown us historically, you're going to tend to make money in the market over the long haul. The problem with gambling is it's an all or nothing, it seems like. Maybe you take $500 to Vegas, and maybe you lose your first $200 and you say, hey, that's enough. I'm having bad luck. I'll walk away with 300. Good for you. I don't like to do that. If I'm going to take $500 to gamble, I'm at least going to throw that money out there, try and hit something big. And if I don't hit it, hey, I planned on losing that money anyway, so it's gone. So gambling's kind of an all or nothing thing. You make a bet on a team, you make a $10 bet on a team in sports. If they win, you get $10 roughly. If they lose, you lose your money. You don't get a little bit of a return or a little bit of a loss. It's an all or nothing. That's why gambling's hard. And that's why you should never commit more money than you can afford to lose with that, because gambling is an all or nothing. Most of the time, you're going to lose a lot. Sometimes you're going to get lucky and hit, and then hopefully you're lucky enough to walk away from it. So I mentioned with speculation, I wouldn't do more than 2% of your investable assets. So if you got 50,000, speculative $1,000. If you got $1 million, no more speculation than say $20,000 in stocks or different investment ideas. When it comes to gambling, I would slice that way down. I was trying to think of a fair number for that. Let's say you've got $50,000 invested in your 401k, your Roth. You've got, 1,000 of that is in speculative electronic currencies, some company your friend works at in Germany, whatever it may be. You've got $1,000 invested in that, which is 2%. Gambling, I would not do more than 0.25%. That's 25 basis points, 1/4%. So if you've got $50,000, you should not be gambling more than $125. You should not be risking losing more than just straight $125. So think about it though, as you earn more and more money, you can gamble more and more money. You can be a little more speculative because it's a percentage basis. And as long as it's a percentage basis, you're going to be okay because it's not going to overwhelm. Think about if your speculation and your gambling completely bombs, hey, 2.25% of your overall portfolio did nothing for you. And maybe you learned your lesson. You don't like gambling. You don't like speculation. And like I said, as I've gotten older, as I've gotten more and more assets, the investments have become plainer and more boring. And every now and then I'll do a $5 bet here or there, or, a $10 bet, but definitely nothing extravagant for me. So if you've got $50,000 invested, $1,000 speculation, you're going to Vegas with $125, win or lose. Good luck to you. You got $1 million, you've got 20,000 in speculative electronic currencies and your friend's company in Germany. And maybe over the year you gamble $2,500. That would be 0.25%. That's still a lot. I mean, I think that's a lot. That's too much for me. But if we're looking for numbers here, at least it gives you some guardrails to go with. So think about it. Think about your assets. Think about if you like gambling, this and that, with your different accounts. Is that fair? Are you treating it right? Are you doing the right things? Are you enjoying gambling? Are you enjoying speculation? Are you enjoying investing? And if so, then you should be doing it right if you're enjoying it. If you're sweating it out, if it churns your stomach when you lose money, then it's not for you. And the same thing goes with the stock market. It's so tough for people because some people just can't get themselves to invest in the stock market. They see, maybe they see a 20%, 10%, 15% return over 3 years in the stock market, but then the pandemic or something comes along and all of a sudden their accounts start losing 20, 30%. They can't even stomach that. And that's where you have to be able to take on a little bit of risk, a little bit of risk for the stock market, definitely a lot more risk for speculation and a ton of risk for gambling. And I think as you invest more and more in the markets over time and you go through different phases of pandemics and bank crises and internet bubbles, you'll see that things tend to bounce back over time. And that's why you need to stay invested and not be selling out of your good quality companies, your Johnson & Johnson's, your Cintas, your Illinois Tool Works, the S&P 500, things like that. Speculative companies, ride them out. If you're willing to ride them out, as long as you've invested just that small amount, ride them out. And gambling, hey, good luck to you. Hope the Guardians win, hope the Browns win, which we all know is very rare to happen, but we suffer through it. So with that being said, I hope you found this enjoyable. Just something a little different, being Derby week here and thinking about gambling and everything that goes along with that. Terminology standpoint, I hope maybe it sets something in your mind about thinking about, hey, what I'm doing, is what I'm doing investing, or am I guessing and speculating, or am I gambling? The majority, 98% of what you're doing should be purely investing. And then, take a little ride with a little bit, and maybe someday we'll be talking about you in a Yahoo Finance or a Twitter post or something about how you made millions. Good luck to you. It's rare, but hey, it does happen, and one can dream. So again, I want to thank you all for joining me. Kevin, his song, Rain Over Money, talking about investing, speculation, and gambling today. Any questions, comments, please feel free, shoot me a note through rainovermoney.com. Visit us on Instagram, Twitter, and check us out on YouTube and wherever you get your podcast from for other episodes as well. Again, I'm Kevin Hissong. Hope you have a great day, great rest of the week. If you're betting on the Derby, good luck to you all, and have a good one. We'll see you.